So weak quarter for Zee Entertainment as revenue growth slows on curtailed ad spends. Subscription revenue, however, grows aided by organic growth in Z5 and Zee Music.
Nykaa's third quarter revenue grows by over 30%, but the stock corrects as the margin slips nearly 300 basis points in the quarter gone by.
Brokerage house Motilal Oswal downgrades IGL to a sell, says EBITDA will come under pressure with most of the incremental demand coming in from the industrial segment.
Allcargo's revenue and profits dip as the lower freight rates impact the performance. RHI Magnesita delivers its lowest margin since September 20th quarter. The profit too slumps. The problem is they're also looking at raising equity, which is a bit of an overhang.
All India's post-earnings rally continues for the second day. An up move in crude oil prices over the weekend also aids the further uptick that we're seeing on the stock.
Hello and welcome to Chartbusters. I'm Nigel D'Souza and joining me as always is Mangalam Malu. Well, Mangalam, we have a big queue coming in later this evening. That's a CPI print coming in from the United States. But for the time being, at least the markets are holding in the green. And as we pointed out earlier today as well, that the IT index could see a bit of a bounce. Remember, for two sessions, it's been a relative underperformer. It's taken a knock of closer on 2.5%. Today, that's the one that's leading the way. It's up closer around 1.5%. Mangalam, we've got a little bit of pink, little bit of red. I think it's in line with the theme, 14th of February. But Nykaa's under some pressure. Tell us, his numbers didn't look very good.
Nykaa indeed is under some pressure, Nigel. You know, I'm looking at a couple of things. While the revenue growth for the company decent, 33% jump, gross merchandise value growing by about 37% as well. There has been a near 290 basis points decline in their gross margins. And the company has tried to curtail the EBITDA margin decline to about 100 basis points itself by lowering its marketing expenses, lowering its fulfillment expenses as well. Net profit is lower by about 71%, largely due to a 2x increase in non-cash expense, which is depreciation. Beauty and personal care. Out there, the revenue grew by 26%. Fashion, which is a relatively lower part of their business, grew about 50%. And other new businesses on a much smaller base grew 254%. And that is something that the brokerages don't like, because they're saying that, you know, fashion, which is a driver, has driven the revenue this time, and as has the other new businesses. But the core of the business, which is beauty and personal care, has grown much slower than the overall pack of things, and that's the reason why the margins have come in lower as well, as a result of which we've seen a bit of a decline in the stock price. Having said that, let's see where it goes from here, because will demand come up or not is the question we need the answer to.
Okay, all right. So that's about Nykaa. But let's focus on a couple of numbers. Thankfully, it's almost the end of earnings season. It's been quite a rough one for the last few days. But today, we'll probably be pulling the curtains down on the earnings season. But a couple of companies came out with a set of numbers. So let's get straight to that. Global Health reported strong revenue growth in the third quarter. The company also maintains its margins around the 23% odd mark, while the profitability was much higher in trade. We have the chairman and managing director, Mr. Naresh Trehan, as well as Pankaj Saini, the group CEO, who joins in on the show. Good morning, gentlemen. Thanks so much for joining in. Well, let's discuss a couple of those numbers then. The occupancy was at around 59% for the past quarter. Could you give us a sense what was the surgical mix in there, and what's the trajectory in terms of occupancy from here on? Go ahead.
Take it, Pankaj.
One of the key aspects for us as we move forward out of this 9 months and the last quarter is we've seen revenue growth by about 21%, EBITDA growth 22%, and profit after tax growing about 26%. So we are very confident and very happy with our performance so far. We've also added in a significant number of new beds. As you may be aware, our Lucknow and our Patna facilities continue to ramp up beds. So as you see the installed bed capacity increasing, added almost 170 beds in the last few months, you will see that the installed capacity will increase. Our volumes have grown about 31% over the 9-month period in terms of our inpatient admissions. So all in all, very strong performance across all of the units. Fairly happy with the growth that we see coming in. And we continue to focus in on strengthening our core. We've added some leading clinicians into our mix. Dr. Randeep Guleria joining us in our Gurgaon facility.
You know, Pankaj, we have a fair sense in terms of your numbers, and we appreciate the efforts that you're putting in. But from a stock market perspective, you'd like a couple of quantitative details. One is, how does the occupancy move from here on? What would the surgical mix be out there? And also, if you could give us a sense on the average revenue per bed. So both these two numbers. Let's take it.
So our average revenue per bed, as you see, is about 58,000. That's without considering our outpatient pharmacy. If you add that in, that comes to about 60,000. And that's grown about 10% over the course of the last 9 months. Continues to be at the top end of the market and continues to be strong, given the complex work which we do. You asked about our surgical mix. A lot of our caseload is very high-end, high-complexity surgical work. We get about 80% plus of our patients' revenues come in from our inpatient work, the majority of which is high-end surgical work. As you look at our occupancy trajectory, we see that fairly strong. The important point to mention, though, is that we will see capacity addition, and as capacity addition kicks in, you will see some amount of variability in occupancy because the denominator keeps changing. But the important point to note is that our occupied bed days have grown by about 10%. Our inpatient volumes are growing about 30%. So since we are in a growth phase with our bed additions, you will see some amount of variability in the occupancy at a group level. But overall, we continue to see strong momentum across the units.
All right. Could you give us a sense on a couple of things then? Dr. Trehan, just wanted to understand your thoughts on EBITDA margins. This time around, it's coming at 23%. Is it sustainable as, occupancies increase further, but at the same time, you all will be investing in newer capacities as well? So thoughts on that. And the second one was on international patients. While your overall business grew slightly upwards of 20%, the international business on a low base understandably grew over 80%. It forms 6% of your revenues right now. Where do you see that number headed? What was it pre-pandemic? So on EBITDA margins and international patients, Dr. Trehan, if you could give us your sense.
So you know that we are actually providing the highest end of medicine, whether it would be cancer, whether it would be surgical specialties. So we continue to move up the value chain in cutting-edge treatments. This has been our core strength, and this is what we maintain no matter whether it's in our flagship in Gurugram or in the new facilities that we have created. So we move on like on a daily basis, we are creating new things. So like even in the last quarter, we added lung transplants. Now, lung transplants, we've successfully started the program. We've done several and successfully. So we then have also brought in several new physicians who are doing like high-end, like we have one team which has joined us for uro-oncology. They super specialize in robotic uro-oncology. Then we have added mother and child in Lucknow and in Gurugram. The basic thing is that we are the cutting edge on critical care. So even in the mother and child, which is traditionally just babies and all, we have a very large system for critical care for neonates. We don't come from our own facilities, but from all around where newborns are sick and need specialized care. Similarly,
Dr. Trehan, we understand. Dr. Trehan, we understand and we thank your commitment to society and the ability that you want to bring the best of the lot to patients, etc., and bring out critical care too. But Pankaj, if you could give us some quantitative details, margins, where do we see them going from here? And international patients, when do they go back to pre-pandemic levels?
So let me start with your second question first. International business, which pre-pandemic was about 8 to 10% of our top line, has not yet reached the levels that they were before COVID, although we do see some growth coming back. Currently, about 6 to 7% of our top line is international business. We've seen some substitution from patients coming in from Afghanistan that now getting replaced with other countries. So we see strong growth in Iraq, Bangladesh, a lot of CIS countries, as well as a good amount of potential for patient growth from the African continent as well. So we feel good about the international business as we move on. There's also a lot of momentum from the government with the Heal in India and Heal from India initiatives. So that should help the industry as a whole in terms terms of attracting medical value travel patients. In terms of the EBITDA margins, we've been maintaining strong EBITDA margins at about 24%. We see that there is no reason for any kind of worry on those. As you are aware, we don't give out forward-looking statements, but with our expansion into our additional beds in Lucknow and Patna, we do believe that the incremental growth which will come in, given that we've already put a lot of investment into the ground, we've already got the teams in place, will of course be able to deliver revenues at a higher marginal profit, because the cost, of course, to serve every incremental patient is significantly lower. So we've been fairly strong with our performance over the quarters. We feel confident as we move into the next quarter as well as in the subsequent years. And we've also continued our growth. We've added on a 300-bed hospital, which we will be having in Indore as well on an asset-light model. So growth all around, both in occupancy as well as performance.
All right. Thanks so much, Pankaj, for joining in, Dr. Trehan as well. And before we wrap up, I have a colleague of mine who's just outside the studio, and they've just given me some feedback on my mails that your facility in Patna is top class. The colleague's mother is admitted out there, and he believes that the service you're providing out there is absolutely top class, much better than any of the hospitals in the vicinity as well. So kudos to you and your team. It's just a feedback that I just got in, so I thought I'll share it with you all. All the best. We look forward to discussing financials as well the next time we chat. Well, for the time being, though, we'll slip into a short break. Actually, before that, let's shift focus to our special segment where we get you a few ideas for profit. So let's sneak that one in. We have Krushna Gupta who joins us to give us a stock that she's tracking very closely. Krushna?
Ruchira Paper has carved its niche in the Indian paper industry with timely diversification of the product profile and improvement in the operational efficiency. All of these are getting reflected in the recent quarterly performances of the company. On the earnings front, the past 3 quarterly results have been good, adding confidence to the sustainability of the business model. Now coming back to the December quarter results. The company reported strong year-over-year numbers in Q3 on the back of volume growth coupled with higher sales realization across product categories. The positive results could also be attributed to the altered product mix as the company reorganized its production capacity by allocating writing and printing grade paper capacity to the value-added products such as wedding cards, cups, stocks, and copiers. This also resulted in a substantial year-over-year improvement in the margins in the December quarter. The new education policy and full-fledged work in office are also driving the demand for writing and printing grade paper. Ruchira Paper is trading at 3.7 times EV by EBITDA and 4.8 times PE on FY24 earnings. The reasonable valuation compared to other moderately sized paper companies makes Ruchira a worthy bet. Also, Ruchira is a fundamentally strong company with focus on adaptability coupled with improving ROE, which is expected to reach the pre-pandemic level.
All right, with that, we'll step a short break. Come back on the other side. We have with us Ravi Jakhar, who's the Chief Strategy Officer at Allcargo Logistics, to discuss the company's third quarter earnings in detail. Welcome back. The stock of the moment on the downside is Allcargo Logistics. There was a swift, decline in the stock price, primarily on account of the weakness that we've seen in their third quarter performance, led largely by a decline in freight rates, as a result of which the company's EBITDA has fallen by almost 47%, and we've seen the net profit fall a lot more as well. We have with us Ravi Jakhar, who's the Chief Strategy Officer at Allcargo Logistics, joining in to tell us more. Ravi, thanks a lot for joining in. If you could first clarify a few details. One, what were the volumes that you handled during the quarter? How do they compare year over year? And secondly, what was the quantum decline in ocean freight rates during this quarter? Where do they stand at now? What can we expect going forward?
Yeah, thanks. It's always a pleasure to be in your show. First of all, let me clarify that the percentage comparisons which are being made are perhaps a little misplaced, because when you look at the quarter-on-quarter comparisons, we have received the demerger order which has been uploaded on the NCLT website, and therefore we were obligated to show as continuing and discontinuing businesses, which I believe has led to some confusion on the numbers. So to respond to you on the volume on a year-on-year basis is flat. the market has overall degrown, but we have expanded the market share, and therefore the market, the volume for us for LCL and FCL, which is the key businesses, remains flat year on year. On a quarter-on-quarter basis, we have seen a decline of about 2%, 3% in FCL, and about 7% in LCL, both far below the market decline. As we have expanded the market share, and for the first time, we now hold 15% of the global LCL market share. Quickly to comment on the EBITDA, the best way to look at would be to look at the combined EBITDA, which is as the companies get demerged, because it's a mirror demerger. So as the companies get demerged, the continuing company, Allcargo Logistics, would have the international supply chain, express and contract logistics business. These three businesses put together for this quarter 3 FY23, EBITDA is about 268 crores. And if you actually add the EBITDA for the other discontinuing businesses, which are for the like-to-like comparison, the EBITDA number would actually be about 350 crores. So that's the key number. I think there's been a little bit of confusion with.
So that's still a 30% decline, Ravi. That's still a 30% decline, right? And comparable top line, what would it be? I mean, you've reported 4,100 versus 5,600. It's a decline of 27%. Comparable for the demerger, what would these numbers be? Because right now, the numbers that we have reported, as per you, 27% decline in the revenue, 47% decline in the EBITDA, 62% decline in the net profit. As per you, if you do not demerge the businesses, what is the comparable number? Can you clarify?
Yeah, sure. So if you look at the comparable number for the continuing business, which is what we have provided as well, the comparable number is about 5,078 crores, has come down to about 4,099 crores, which means that we're talking about a decline of about 979 crores. It is important to note that a large part of our revenue is ocean freight, which is largely a pass-through cost on the largest LCL business. So if you look at the operating expense, while the operating revenue came down by 979 crores, operating expense also came down by almost 900 crores. So it's almost a pass-through impact on the LCL. There is some partial impact on the FCL business. So data is only about 79, 80 odd crores. So that's the key thing to note here. And the comparison has to be on a like-to-like basis, not with the overall consolidated and the continuing business, because this only represents a part of the business. So this is the way to look at this. Revenues have come down because the ocean freight rates have corrected. At the gross profit level, the impact is much lesser because the operating cost is also almost in the similar proportion come down.
Okay, all right, Ravi. So one crucial clarification that you're giving us is the volumes are flat, instead of a decline, degrowth on a like-to-like basis. So that's important. The street was fearing that. But let's get a couple of numbers out of the way. What's the sustainable quarterly run rate for the international supply chain business? Can you do 5,000 crores per quarter? Point number one. And point number two, on a like-to-like basis, FY24, what kind of a revenue growth and EBITDA can you guide us? Go ahead.
Yeah, so I would say that we will not be able to share the future guidance on exact specifics, but what I can say is that the best would be to look at the gross profit, because revenue, as I mentioned, has the ocean freight component, which is mostly passed through. From a comprehensive performance perspective, expect January and February, because the China lockdown and all only eased after the Chinese New Year. So expect January to be a subdued month in line with the current quarter. And from Feb mid onwards, expect a pickup in trade volumes. From a market positioning perspective, we are absolutely well placed. We have been growing market share. So that is something which is very, very comforting. We would continue to gain the market share, and therefore, as the volumes bounce back in the global trade, which we expect that they've already started showing trends from mid-February onwards, the volume should start picking up, and there's a multiplier impact. So I would say that there could be somewhat sluggishness in the Jan to March quarter, and from April onwards, expect the growth to rebound to earlier levels in terms of the getting closer to those numbers on the bottom line. On the top line, of course, the revenue would be impacted by what the operating freight rates look like. And
the FY26 target of 25 to 30,000 crores is still intact. That's guiding you, right? With 9 to 10% margins.
Absolutely.
All right. No, just a final question. Right. What's the debt on your books right now? I mean, the last quarter was close to around 1,400 odd crores. You have plans to repay that. What's it at right now?
Yeah, so because of the strong operating cash flows and the long-pending Blackstone transaction, which is now consummated, I'm glad to share that on a consolidated net basis, our debt as of 31st December was about 130 crores. After December, we have signed off the Blackstone transaction, which has taken away debt of about 285 crores and also brought in cash of about 120 crores. So as we speak today, we are sitting on cash positive. There is absolutely no net consolidated debt in the company. And we have enough cash flows to even take care of the other acquisitions which we have already announced and are lined up, such as the acquisition of stake in Gati KWE. So even if you look at the 31st March ending number, we would have completed all the pending acquisitions and would still be on a consolidated basis, net debt would be 0. So we are very strongly placed on that. Yeah.
All right, Ravi, thank you so much for joining in and giving us a quick take on these numbers. We would have loved to speak to you more, but unfortunately running out of time. Hold that conversation for another day. With that, take a short break, come back, get you more on the markets and individual stocks on the other side. Stay tuned.
Well, we've been talking about the IT stocks doing well and the IT index holding up. Reliance and Adani Ports, both those two Nifty constituents, they have moved to the high point of the day. Reliance is the big one in there because that has a large weight on the index. But we've completely run out of time on this edition of Chartbusters. You stay with us. Trading Hour comes up next.